Thanks for listening to Investor Insights, a behind-the-scenes look at investing with Fund That Flip. This series provides an insider's look at how our business works and answers your frequently asked questions so that you can make better investment decisions with your hard-earned capital. Now, our founder and CEO, Matt Rodak.
Welcome to this episode of Fund That Flip's Investor Insights. I'm your host, Matt Rodak, founder and CEO here at Fund That Flip. And today joining me on the show is Mathias Karlen, an active lender of ours here at Fund That Flip. Mathias has invested in nearly 100 projects now, dating back to, I think, around October 2018 is when I could see your first investment. He's also been making some investments over the past couple of weeks as we've been working our way through the COVID pandemic that we all find ourselves in. So that'd be a great time to invite him on the show and share his perspective on all things real estate investing, particularly in these times. So with that, welcome to the show, Mathias.
Yes, thank you for having me. You know, I've listened to my fair share of podcasts over the years, but I've never actually been on one personally. So this is a treat. So thanks for having me.
Oh, awesome. That's great. I'm oddly enough not a big podcast listener, which is strange because I have a podcast, but it's good to know there's people pod listening as well as podcasting.
You must not commute much. I feel like the relationship of podcast listening to spending time in one's car is directly proportional.
That's what it is. I formerly had a 10-minute walk from the office to home and vice versa. So that probably does one of the benefits of living in New York City, I guess. Mm-hmm. All right, cool. So again, appreciate you taking the time. Excited to have you here. Before we jump into investing and generally across the space, but also in the current environment that we find ourselves in, would love to just get your background, how you got into the space, and what you're doing when you're not investing in real estate deals.
Sure. Well, so I'm originally from Switzerland. I'm in my mid-30s. I grew up in the States, happily so. But interestingly enough, I kind of discovered the space while I was in Switzerland getting my master's, and kind of unexpectedly came into a small amount of money. And I had this, what I thought was a genius idea, that I would try to find a way to put this money to work such that it would cash flow, so that I could be a cash flow student. And so I kind of looked around to see what opportunities existed. And this was right around the time that peer-to-peer lending started to take form. Some of your listeners may be familiar with Lending Club and Prosper. They were kind of the early actors on the scene, kind of connecting borrowers and investors such as myself, them specifically in the consumer space. And so I really kind of learned about the asset class, learned about the mechanics, put some money to work, kind of realized my goal of being a cash flow student, which made me very proud, and just kind of continued to follow the space as it evolved from there. And it kind of naturally gravitated into other asset classes, one of which, of course, was real estate, specifically kind of short-term fix and flip debt, which is, of course, the product that you guys offer. And I quickly discovered, this vertical as being inherently superior for a number of reasons relative to consumer debt and a few of the other verticals that I was taking a look at. So I got quite bullish on the space and really started to transition more and more of my portfolio, or at least the part of my portfolio that I wanted to cash flow, kind of into the space and familiarized myself, with it. Because I was initially a student, my perspective was always passive, and I thought that this was a great way to get kind of passive exposure to what has otherwise historically been a really reliable asset class, which of course is United States residential real estate.
Yep.
So that's kind of how it all started.
Got it. Very cool. And I don't know if you know the founding story of Fund That Flip. We did put, I think, a podcast out on it a while ago, which you guys can check out. But the lending clubs and the Prospers were actually one inspiration for starting Fund That Flip. I was investing on those platforms myself back in 2010, 2011. Right. And back then, right, you could get 11, 12% coupon after adjusting for losses. I was also borrowing money for my real estate flips at 18%, and did the math like you probably did when the real estate peer-to-peer came online and said, hey, these are paying a higher interest rate and have real collateral.
Right.
That doesn't make sense.
Right.
Let's go put some money over there. Yeah.
Yeah, absolutely. Yeah. At first I thought it was almost not right. Like I was convinced I was missing something. I mean, you had shorter duration, you had, comparable yields or potentially even higher yields at the time. You had, collateralized, the loans were collateralized. So on basically on all accounts, it was kind of a better deal. So once I became comfortable with the idea that I kind of knew what I was doing, it was easy for me to transition the portfolio over, not wholesale, but
Sure.
a large portion of it.
Sure. That's interesting. Yeah, and I think that's been the case for a lot of folks, right? Is initially got used to this idea of lending people money online through the P2P guys and other entrepreneurs with a perspective on other types of credit have started to bring additional products online, which I think has benefited everyone, right, on both sides of that trade. Certainly, investors now have access to like you said, invest in this asset class passively, which having flipped houses is much more attractive to me than actually flipping a house. Right. But also can, benefit from broader diversification and on the other side of that, our borrowers, right, have more access to capital with a lot easier kind of path to get funded. So it's been I think a win-win across the board. All right. So got into real estate. I get asked this question a lot. So I like to ask people on the other side the same question. People call in all the time and say, hey, Matt, I want to invest. What's the best investment that you have right now on your platform that I can invest in? Right. And to me, best is subjective, right? Because it really depends on your perspective on a lot of different things and what you're trying to achieve. So I'd like to ask that question back to you, right? Not specifically like which investment on the site do you like right now, but when you're looking at loans to potentially invest in, and like I said, you've made almost 100 now on the platform, so you've got a lot of experience at this that I think others could benefit from. What are you dialing into? What are you looking at? What are the different data points or other things maybe that you're taking into consideration when making an investment decision?
Yeah, happy to speak to that. And, that answer has certainly changed a little bit as a result of, the current situation in which we find us. But I'm sure we'll get to that in a moment. But for someone like me who enjoys, it sounds paradoxical, but enjoys actively investing passively, meaning that I enjoy looking at, the different deals that you offer, the different deals that are out there, looking at all of the different variables. For me, it's really hard to answer your question because, there's so many things to look at and they all kind of operate in relation to one another. As an example, usually I'm not so interested in a borrower that has no experience whatsoever, and this is their first project. But if you are lending at, an insanely low LTV, let's say of, 40%, well, then maybe I'll consider it, right? Whereas otherwise I wouldn't. So it's a little hard to answer. It really kind of, you kind of have to, I really tried to get an overall picture, bringing all of these variables into account in relation to one another and then kind of analyzing from there. So I'm not sure how helpful that answer is for people who are listening, but that is kind of the reality of how I'm looking at things.
So you did mention two things there, right? So you mentioned experience is something that you care about, and you mentioned loan to value is something that you care about. And you're doing what we do internally when we're underwriting loans, and it's adjust based on compensating factors, right? So, just to look at a loan and say, oh, that has a 65% LTARV or an 85% LTC, taken by itself isn't, I don't think, all that useful, right?
Right.
Because if that's a higher ARV and a higher LTC with no experience, that may be actually a slightly more risky loan than lower LTVs or similar LTVs with no experience, right? So having a holistic view of the whole picture is certainly important.
Yeah, I would say one thing that maybe differentiates me from some investors is I really don't have any kind of automatic disqualifiers, or very few. Some people, they'll say, if the FICO is not 700, it's automatically I'm not looking at it. And I know certainly on the institutional side, institutional investors, they definitely sometimes have very rigid buy boxes.
Yep.
And I've always tried to be a little bit more flexible. And, it takes more work, certainly, to understand, the big picture and how all these variables relate to each other. But I think that allows you also to be the most opportunistic.
Sure. What about geos? Do you have a perspective on a certain geography that you like or don't like? And we're going to get into a little bit of portfolio construction here in a minute, but are you focused on judicial, non-judicial states or any other,
Yeah, you kind of hit the nail on the head there. I think that judicial versus non-judicial has more relevance given kind of I don't know if you want to call it the post-corona world or the new corona reality. Just in the sense that, depending on the state, judicial process could be very long as it is, but now we have moratoriums, you have, courts that are potentially closed, you have courts that are going to be backlogged once they're finally open again. So again, I wouldn't say I'm not going to look at something just because it's in a judicial state, but you have to be very conscious that if you do invest in a judicial state and the deal has problems, it could be a very long time before you get your principal back.
Yep.
So, yeah, I definitely look at that. And I would also say just, geographic concentration. I try to stay diversified, and unless I'm really familiar with a certain market, I'll put a certain amount there, but try not to go, too heavy in any one place. We all know that real estate is local, and a lot of markets I don't know super well, right? Because I don't live there, and so I'm respectful of that and cognizant of that, and therefore I try not to go too top heavy in any one geography.
Yep, makes sense. And there's even some nuance between judicial and non-judicial states. There's certain judicial states that allow different types of provisions within the note that can expedite the foreclosure process. So, we're going to try to put some more info out on that stuff, like Ohio and Pennsylvania and Massachusetts have some different ways to get to the collateral a lot quicker than going through a traditional judicial foreclosure process. And these are commercial loans, so they're handled slightly different, sometimes even at the federal court level. So not that we need to bore everyone with all that details, but I think going back to your point on, one, not just automatically disqualifying things based on things and adjusting for compensating factors are all, I think, important things when you're putting together a strategy. All right. So before you get into the portfolio kind of construction, because I do want to go there, and you mentioned it a little bit. You also mentioned that things have changed a little bit for you post-COVID, right? So other than judicial, non-judicial, what else are you kind of considering, or how are you thinking about things kind of today on April 14th, 2020, as things change quickly?
It's good to throw in the date because, I don't know when this is going to get published, but the world is already might be way different by then, right?
Yep.
I think, it sounds a little cliche, but for me, it really is going back to the basics. And to me, the most basic thing that one can pay attention to is, how much cushion is there in a deal? So, depending on the deal, that might mean you're looking at loan to value. You might be looking at loan to cost. You might be looking at, loan to after repair value. But, for me, I'm really putting a premium and really putting an emphasis on deals that are underwritten more conservatively in that sense, meaning, there's more of borrower equity and less leverage. Simply because we're in unprecedented times, and, a lot of people speculate about what's coming and what the world's going to look like, but the reality is no one really knows for sure. So the best way, in my opinion, to compensate for that is to really go after deals that just have a little bit more cushion in there. I think one mistake that I see some people do is pay a little too close attention to yield. We've definitely seen an increase in yields, kind of really everywhere across the board. I know that's certainly been the case on your platform, but you are by no means alone. And sometimes I think investors get very starry-eyed when all of a sudden they see yields that they may not have seen in the last 3-4 years. And yield is certainly a variable to take into consideration, but for me that is really kind of secondary. The way I like to think about it is today I underwrite much more to the downside than I do the upside. Meaning, I look more kind of from a conservative perspective, what kind of safety do I have in place first, and then, what kind of money can I make? I look at second.
Yep. Makes sense. Not that that's a bad practice in good times, but particularly important in evolving times, if you will. What about just overall asset allocation? I know that the show here is real estate investing, but have you kind of shifted asset allocation at all based on any new opportunities you're seeing in the market?
I've certainly, like just about everybody, it seems, I've certainly gone a little bit more to cash.
Yep.
Part of that is, out of being conservative, but part of that is also just to have dry powder in the event that opportunities present themselves in the near to intermediate term. That said, with respect to the asset class that we're talking about here, short term debt, I do remain ultimately bullish. I think in times like this, it is a little bit of a safer way to still get a healthy return. Mm-hmm. So I'm, aside from moving some money to cash, I'm otherwise not really moving out of the space. Even if I am being more selective in the individual deals in which I put money.
Yep, makes sense. Somewhat defensive, somewhat preparing to be offensive should opportunities present themselves.
Correct. Yeah, that's a good way of describing it.
Makes sense. So talk to us a little bit about portfolio construction theory, if we want to call it a theory. How do you think about, you mentioned some things, geographic diversification. Are you doing anything else from a diversification perspective? Do you ladder maturity dates so you've got some liquidity kind of on a rolling basis? I don't know. There's a lot of different things there, but talk to us what you kind of do and how you think about that.
I'm glad you mentioned diversification because I don't pretend to be any smarter than I am. And I'm conscious of the fact that there's a lot that I don't know. And I think the current situation that we're in is a great example, right? I had no idea that a pandemic was coming. Obviously, most people didn't. But I think the time-honored best way to protect against that is to diversify, and that can mean a lot of different things. So we talked about geographic diversification. Can also mean diversifying who you're lending to, making sure that you're not lending too much to any one person, not lending too much across any one platform. Right? There's different platforms out there. That's another way to diversify. There's, diversification between judicial and non-judicial, even within the capital stack, right? If you want to say, okay, well, that's maybe not so much, right? I mean, I'm certainly going more into just the debt side, not the equity side as a conservative play. So I guess in that sense, I'm decreasing diversification. But yeah, I mean, most of the variables that you look at, you can think of them in terms of diversification, I think, right? So if you are putting a lot of money into loans that have very little equity cushion in them, you can say, okay, I want to diversify against that. I'm going to do some more conservative loans as well, right? If you have some higher quality paper, you diversify that with some lower quality paper, or I guess in this case, it would be more vice versa. But I think really most of the variables that you look at as you underwrite a deal, you can look at from a diversification perspective. And if you do too much in one thing or in one place or with one person or what have you, think about ways in which you can diversify away from that.
Yep. Yeah, I think that's the strategy that we like to encourage people to consider. I guess it's one of the benefits, right, of platforms like ours is the minimum entry point is $5,000. So you can spread that, whatever that allocation is, if it's 50 grand or 100 grand over 10 to 20 projects. We like to say 20 is a good number to kind of really build a diversified portfolio. We occasionally see some people come in with, they make 3 investments and they're large, and that always makes me a little bit nervous. Unless you really have a particular insight on the project or the borrower or the location. I like the pick a lot of loans strategy a lot better.
Agreed. And you hit the nail on the head. That's really one of the great services that, Fund That Flip and a few others offer is, the ability to diversify, to spread across many different projects without a huge amount of capital, right?
Yep.
So, otherwise doing what I do just wouldn't be possible. I'm not a hedge fund. I'm not a huge institution, that there's only so much to invest, right? And so if you want to be diversified, it really helps to be able to fractionalize that out and split that up.
Yep. All right, people, diversification, that's the strategy. Take advantage of the low investment minimums. All right. So last question here, Mathias. I'd just be interested in hearing your opinion. You sound like a guy that's pretty dialed into what's going on from an economic and investment perspective. How do you think we come out of all this? Again, April 14th, 2020. How do the next couple of months play out? We did a podcast earlier on the shape of the recovery, right? Is it a bounce back quick? Does it kind of drag out for a long time? And then, maybe you could add to that, what impact do you think it has on the real estate market, if any, long-term, short-term, long-term?
This is now the moment since we're recording where I can make a genius or a total fool out of myself. If you're
binary outcome. Yes.
Yeah, that's right. So I'm going to take I told you I'm from Switzerland. I'm going to take the conservative, neutral approach here and confess that I truly don't know. Is it going to be a V-shaped recovery, a U-shaped recovery? Will the virus be contained, or will there be a second wave, and what will that mean? What I will say is, and this is really why I remain comfortable with the space, is, I think real estate has a certain floor, and that is predicated on the fact that ultimately people need and will always need a place to live. And so, certainly real estate value can go down, especially if you're talking at higher price points and kind of, the luxury market, the potential to decline is obviously greater. But I take a lot of comfort in the fact that, we're talking here about an asset that people fundamentally need and will continue to need. And I think a really good way to illustrate this, and forgive me because I know I'm not really answering your question directly, but I saw a few days ago that Carnival, the cruise ship company, they have liquidity problems, and they put out a debt offering, something like 12 or 13%. So I thought to myself, well, would I want to partake in this debt offering at 12 or 13%? Collateralized by a cruise ship, presumably. Or would I rather try to make, the same kind of coupon collateralized by, a single family residential house?
Yep.
And I think that made it kind of clear to me. So, while I hope we have a V recovery, maybe we have a U recovery, but I like to think that, I will be okay in either situation. So that's really how I think about it. As far as predictions go, I don't know anything that anyone else does,
It's a very Swiss answer of you. Thank you.
I warned you. I said you were going to be disappointed.
No, I mean, look, you're right. No one knows. I think the housing story is right on, right? And I think two or three things that go into that from how we're thinking about it again on April 14th is going into all this, right? We had record low supply of housing. Right. So you mentioned you're out west, Pacific Northwest, and some in California, less than 3 months of supply in some of those markets and kind of across the country when healthy supply is 5 to 6 months, right? So I think at this point it's safe to say there's going to be some impact on the demand side of the equation for housing. But the balancing act there a little bit is we didn't have a whole lot of supply going into it. So I like what you said there's a floor here, right? We're not talking about can people afford to go on cruises. It's do people need a place to live?
Right.
We also have $2.2 trillion of capital flowing into the system, and that's going to inflate something. Hard assets are typically a pretty safe place to put a bet on where there's going to be some inflation or nothing else.
I think speaking to that, there's a little bit of uncertainty where all of this stimulus money will end up. But I would think that, a safer bet is to assume in housing, if for no other reason, than on account of the fact that, mortgage rates are very easily manipulated, by this type of action that we're seeing, and they're, what they are today, right? They're rock bottom and likely will continue to be so for the foreseeable future. So it's hard not to imagine that will continue or will contribute to the thesis, that housing has to have some kind of floor. In a general sense, it may be market specific, right? In Seattle, which is a market I know very well, you hit the nail on the head with respect to supply. There continues to be massive supply shortages. And so there may be some dislocations in the market and some disruptions, but, is it going to fall out, kind of like the subprime crisis 10 years ago? I seriously doubt it.
Yep. I'm with you there. It's certainly an interesting time to be alive. And I think the next couple of weeks and months will be interesting to see how we start to get back to work and whatever the new normal is. So all being said, really, really appreciate you taking the time here to jump on with us and share some of your perspectives. It was great chatting with you. So thank you very much. And congrats on your first podcast.
Thank you.
Well done. You better be careful. You may be getting some more calls.
I take the compliment. I appreciate it. It was my pleasure.
Yeah, you might have a future here. You should think about starting your own. Who knows? You've got a lot of experience in the peer-to-peer space.
Yeah.
Thank you all for listening as well. If you have any feedback or ideas on topics that you'd like us to cover, or if you have a unique perspective yourself you'd like to share, feel free to shoot us an email at investorrelations@fundthatflip.com. Otherwise, check our blog. We've got a lot of content going up about our response to the COVID pandemic and how we're handling things, and just a lot of other content that I think is useful if you're thinking about investing in the space or already investing in the space. So with that, thank you again, Mathias. Thank you for all that are listening. Until next time, this is Matt signing off.